Jenny Brown. Welcome to this week's MFB News. Hope you've all been out enjoying the sunshine. Isn't it glorious? Such a treat. It did feel like winter went on for like 9 months or something. So yeah, I'm sure you're as appreciative of this better weather as I am. The sad thing is when you're having to just consistently watch it through your office window, but let's hope it stays fine for the weekend for us all. Now, in terms of what we're going to do for this week, we're going to do our usual roundup of what's been happening with swap rates and lender mortgage pricing. I've got a lender who's moved into a whole new lending space, which is quite exciting. We're going to go through that with you and then look at it in the context of the broader market as well. We're going to talk about house prices, what's going on there, and then finally, for those of you who may be thinking about investing this year, we've got a hot list of cities to invest in within the UK. Okay, so if you cast your minds back to last week, for those of you who joined us, you will remember that swap rates had pushed up a bit and 5-year swap rates were over 4%, which is a real kind of biggie for me. It's a bit of a psychological thing. Good news, they've come back down. So where are we? So 2-year swaps as of 11:45 on Tuesday evening were at 3.98. 1 month ago 3.97 and 1 year ago 4.3%. So actually month on month no real change, year on year in a slightly better position, but week on week definitely looking better, which is kind of the thing that I'm very focused on for you guys at the moment. And a very similar story for your 5-year swaps here. So as of last night 3.94. Now 1 month ago they're at 3.85, so they are still month on month higher than they were, but at least they are lower than they were last week. 1 year ago, 3.76. A year on year, we're definitely not in quite such good shape. Probably just glossed over that, to be honest. But the key thing is that the little kind of spike that we saw in the last week has certainly started to settle back down again. So fingers crossed that will feed its way through to the market in terms of lender pricing. What you're going to find is that some lenders who had to put rates up will be sitting on their hands and just waiting for things to really settle down before they drop pricing back down again. Other lenders will react very, very quickly. So I could probably actually predict which lenders are going to bring their rates down in the next few days, but I won't do that because I might get it wrong. But definitely I suspect we'll see a kind of mixed reaction from the lenders, but most lenders will be thinking, well, okay, we saw a fairly quick spike up. Now we're seeing things drop back down. Let's just let the market settle before we start changing our mortgage rates. So let's see what's happening with swap rates next week, and then we'll start making some predictions about what's going to happen with the rates from there. Now, in terms of lender pricing movement, it's been a really, really quiet week. And the reason for that is because swap rates were bouncing around. They're a little bit volatile in the last week. Again, lenders are doing exactly what I've just said, which is just waiting. And so the fallout of this is we've seen very little activity from the lenders. So only really 3 to note. The first one is that Precise Mortgages have made some adjustments downwards. Now these are massive adjustments of up to 1%. So their rates are now from 3.59%. Now for those of you who maybe aren't so familiar with Precise Mortgages, they are a specialist lender. I would say they are a specialist lender who sits more towards the conservative end of specialist lending. So what I mean by that is they can do limited companies, HMOs, multi-units, portfolio landlords with more than 10 buy-to-lets in the background. But it's a kind of very conservative end of that. So small HMOs, small multi-units, that kind of stuff. Precise Mortgages are owned by One Savings Bank, who also own Kent Reliance. Kent Reliance are definitely the more specialist lender who could do much larger HMOs, larger multi-units, that kind of stuff. So Precise, slightly normally cheaper lender, sort of volume-based lending, slightly more conservative criteria. Kent Reliance, the kind of more what to say, racy, I'm not sure if that's the right term, but racy lender for that particular institution. Now, in terms of why Precise have been able to drop their rates down by a whole 1%, the reality is that they were just really, really expensive. So Precise are a lender that I would normally expect to see, particularly in sort of the limited company space, in the top maybe 20 rates in terms of, for example, 5-year fixed, and they haven't been pricing there because they've just been really out of kilter. So what Precise have done is simply rejoin the rest of the market in terms of their pricing matrix, which brings them back in line with a lot of their competitors. So nothing big to read into the fact that Precise have made such a large reduction, other than they're just way out of kilter in the first place. Now we've seen Virgin drop their rates down by up to 0.2%. Again, I think they were pricing a little bit highly, so they've been able to make some reductions. Virgin, vanilla lender, maximum of 10 buy-to-lets, no minimum income. Quite good, I would say, at things like day one remortgages. So these guys can do a remortgage on a property you've owned for less than 6 months, so long as you have really, well, I say done some work to it. They can lend against the property, the purchase price of the property, but if you want to lend against the market value, which in theory should be higher than the purchase price, you're going to need to justify why you've seen an uplift in the property value. So in terms of lenders who are doing the more vanilla end of lending, that's quite a niche thing. And lastly, we've seen TSB bring their rates down by up to 0.15%. Again, you know, very sort of standard lender, no large portfolios for these guys, no unusual property types, but actually if you can access that kind of criteria, then the rates are very, very good. And that's kind of it. So actually, like I say, a really quiet week in terms of pricing changes and also no criteria changes. I don't know if everyone's finishing early for Easter. Maybe people waiting for the spring statement. Who knows? Anyway, so much to think about all the time, isn't there? But hopefully next week we'll see swap rates have eased down a little further and some more lenders come to the table with some new lower rates. Okay, now our friends at Quantum Mortgages, who have till now been a buy-to-let lender only, have launched into the bridging space. Now, just to touch on Quantum first of all as a lender, because they do have some fairly niche bits of lending criteria which I just thought is worth touching on. So just to start this off with the really strong caveat, Quantum are not a cheap lender by any means. They're not kind of eye-wateringly expensive, but you would find that if you looked at their mortgage rates, they are kind of on the top end of specialist lending pricing. However, the thing that they do, which we've given them a lot of business on, or mortgage applications on, is that they don't pay attention to the tenancy agreement. So this works particularly well for those of you who maybe are letting your properties to the likes of Serco. Quantum are totally on board with that. They're just not interested in who the property's been rented to. So just to kind of throw that in at the outset, but this is not what we're talking about today. So what we are talking about is the fact they've gone into bridging finance. Now, the reason I wanted to really share this with you is because actually they've kind of set out their USPs, and it opens up some fairly interesting discussion points about bridging finance. For those of you who are thinking about taking a bridging loan because you want to do a refurb project as an example, and a lot of borrowers find bridging finance really, really confusing, and a lot of people are quite, I want to say, intimidated by it. So there's a kind of real stigma attached to bridging finance from many, many years ago. It's a very different market these days. It's regulated, it's reputable, it's nothing to be afraid of, but actually still some people are quite reticent to take bridging loans, you know, which is absolutely fine. But for those of you who are thinking that actually it could be a useful tool for you, here are some of the things that Quantum are talking about in terms of their unique selling points. So the first thing is they're saying that they're able to deal with auction purchases. Is that an important thing? Yes, it is, because with auction purchases, as you'll know, you normally have 28 days to complete on the transaction, which means that you need a lender who's going to be able to act with real speed. If you've got someone who's going to drag their heels, if they've got solicitors which are really, really slow, completing in 28 days is actually incredibly challenging. So Quantum have put their kind of stake in the sand and said, actually, we can do auction purchases. So these guys are going to need to be able to move at lightning speed. The second thing is they're able to refinance other bridging loans. So what you will find is that if you've got a bridging loan on a property and you apply for a new bridging loan with another provider, probably because you've run out of money on the project that you're doing, so you need to refinance to get some money back out to complete it, you will find that a lot of bridging lenders won't touch you. Why is this? Because they're going to see that actually your project costs have simply overrun, you didn't budget accordingly, you weren't able to stay within that budget, therefore you're not going to be regarded as a great kind of risk. Now this can be quite unfair because, as we've seen in the last few years, cost of materials and labour has absolutely rocketed. So a lot of developers found they came unstuck with that, but still the lenders have this position. Quantum Mortgages are able to refinance a bridging loan onto another bridging loan, so that's really useful. And this is one that I think is going to really pique a lot of people's interest. They're able to lend against open market value rather than purchase price. So if you're able to secure a property for a really, really good price, which is way less than you should be really paying for it, they're able to lend at up to 90% of the purchase price or at 70% of open market value. So the key thing here is, and let's do some numbers. Let's say you're buying a property for £100,000, but its actual value is £200,000. I mean, that would be really surprising if you got that much of a discount of a property, but let's just go with that for ease. So you're buying property for 100, the value is 200,000. So what they're saying is they could essentially lend you 90% of the purchase price, the £90,000, as long as that's no more than 70% loan to value against the open market value, which in this case, 70% of £200,000 would would be £140,000. They're only going to give you 90. It's a happy day. So essentially you're getting 90% lending there. And for a lot of people, this kind of higher gearing against open market value can be really, really useful. The other thing they're doing, they're offering AVMs up to 70% loan to value, where the loan amount is £1 million or less. So again, AVMs are really useful. For those of you who aren't familiar with the term, this is basically a remote valuation, a desktop valuation. It tends to be done by a kind of algorithm which simply values the property. This can be really useful because it essentially speeds the process right up. Now, in terms of property types, just to kind of touch on that for a moment, standard construction houses and flats, no great surprises there. But they can also do non-standard construction up to 60% of open market values. Think back to the example we had of purchase price 100, open market value is 200,000. They could potentially go up to 60% of the 200,000. Obviously, as long as it was no more than 90% of purchase price. They can do ex-local authority flats at 70% loan to value, houses at 75% loan to value, but the caveat here is they must be in an area where at least 50% of the properties in the development are privately owned. They can do flats with deck access over 5 stories, maximum 60% loan to value, and they can do HMOs and multi-units of up to 12 rooms or self-contained units. So some fairly impressive criteria in there. So well done for coming to the market at that quantum. They've obviously thought it through really carefully and tried to make it as all-encompassing as they can. Is it the offering totally unique in the market? No, but actually there are some really good things in there, which I think as much as anything else are a good discussion piece for those of you who are looking to kind of really start to understand bridging finance and the art of the possible that it provides. Okay, now a quick look at what's going on in the property market, and house prices continue to grow at a steady pace in March, with annual growth unchanged at 3.9%. This is according to the latest nationwide house price index. On a monthly basis, prices were flat after adjusting for seasonal factors. Now, Robert Gardner, who's the chief economist at the Nationwide, has said these price trends are unsurprising given the end of the stamp duty holiday, at the end of March. The market is likely to remain a little soft in the coming months since activity would have been brought forward to avoid the additional tax obligations to the stamp duty deadline that we've all been very aware of, a pattern typically observed in the wake of stamp duty holidays. So essentially what he's saying is actually things have been very, very flat. They're expected to be such. It's quite understandable, but actually they are expecting things to sort of really start picking up in the summer. Excuse me. Now, in terms of the kind of more granular detail, Nationwide's quarterly data showed that the UK regions experienced similar annual growth compared to previous quarters. Northern Ireland led regional gains with prices up 13.5% year on year, the highest since 2021, and more than twice the pace of any other area. What's going on in Northern Ireland, I wonder? Scotland saw a 3.9% annual increase, while prices in Wales rose by 3.6%. Across England, the yearly growth rate was 3.3%, which is only slightly higher than the 3.1% recorded in the previous quarter. Going into regions now. Northern England continued to outperform the south, with prices rising 4.9% annually. The northwest was the strongest performer in England with a 5.9% year-on-year gain. By contrast, southern regions posted a 2.5% increase, with the outer southeast seeing the highest growth in the area at 3%. London remained the weakest region in the UK, with prices up just 1.9% compared to a year earlier. Now, in terms of homes and how they're performing, so among different types of homes, semi-detached houses recorded the highest annual price rise at 4.8%. Detached homes properties saw a 4.5% increase, while terraced homes rose by 4.1%. Flats, which were the ones which were doing really, really well going back a few years ago, flats experienced the slowest growth, with prices up just 2.3%, which is a deceleration from the previous quarter. So there you go, the housing market is still kind of trending upwards. Obviously it varies massively depending on where the property is based and what the property type is. But the good news is, despite all the kind of economic challenges that we continue to see in terms of mortgage costs still being probably a little bit higher than they will be going forwards, the property market is still performing relatively well. Okay, now Aldermore have released their buy-to-let city tracker, which essentially has rated cities in terms of how good they are to invest in as a buy-to-let landlord. Now, they're using 5 key metrics when doing their rating systems. There is some science behind this. It's not just like which ones they like the look of and spending a mini breakout or anything like that. So what they say is there's 5 core indicators, which are average rent per room per month, the short-term yield for a new buy-to-let purchase, average property price rise over the last 10 years, proportion of vacant properties in the city and size of the private rental market in that city. So they're using lots of indicators to then kind of make a rating system. And what they've done is they've produced a little kind of league table, which I just wanted to share with you. So first of all, the city which came up tops this year was Manchester. It was voted as best city in the UK, and that's because of its long-term property price rises of any city tested, which was a 6.5% annual growth. So for those of you with buy-to-lets in Manchester city centre, you're going to have seen a really, really strong level of price rises. So the average property price now in Manchester is £243,560. The other thing that the report went on to note is that 32% of the city's residents are privately renting. So that is a huge private rental market there in Manchester, which is really kind of driving up rents, reducing void periods and all those things that this particular tracker is looking at. Now, in terms of other cities, if Manchester isn't your thing, I'm just working my way down from 1 to 10. So in top spot, we've got Manchester, then we've got Glasgow, we've got Coventry, we've got Wigan, we've got Bristol, Portsmouth, Nottingham, Birmingham, Milton Keynes and Peterborough. So those cities are seen as the top 10 most attractive cities to invest in the UK this year. Now, there have been some drops out of the top 10, which include Maidstone, Chelmsford and Bournemouth. The least attractive major cities, I am so sorry if you've got a rental in one of these cities, but according to this chart at least, the least attractive major cities for investment are Wolverhampton, Newport and Swansea. So there you go, it makes some interesting reading for those of you that are thinking about investing. And what I would just say at this moment is there are landlords still investing. In fact, some landlords are viewing the situation that we're in at the moment as a real kind of opportunity moment. There's properties for sale, properties are struggling to sell. As we talked about in previous weeks, actually the reality is that most properties are getting reduced at least once. Mortgage rates are coming down, albeit painfully slowly. And actually a lot of landlords, while they're not happy about the Renters' Rights Bill, are saying, you know what, it is what it is, but this is my business. I'm just going to continue to invest. I still want to grow my business. I recognise that, you know, at the moment I can probably snag a really good deal on the properties that I'm buying. The rental yields are going to continue to increase and actually mortgage costs are starting to ease off. So I think this is a really good place to be. Also, another thing we're seeing a lot of, just incidentally while I'm thinking about it, is landlords buying portfolios from other landlords. So we know there is a real kind of fashion at the moment for divestment from buy-to-let landlords. Not necessarily because they hate being a landlord, although there are going to be some of you that have that sentiment, but actually some people are just, they've had enough, they want to retire, they've reached that age. We know that actually the real boom in buy-to-let happened about 25 years ago. The average age of investor of that time was about 35 years old, which means that actually people are just getting near to retirement, they just don't want to carry on doing it. So there is a real wave of properties coming onto the market from landlords and portfolios coming onto the market. So landlords just selling off the whole thing or a real bulk of properties. And we're able to finance these incidentally. So if you are thinking about buying a portfolio of C1 for sale, give us a ring because we would be able to help you with that. And there's some pretty sort of neat ways of being able to finance such an acquisition. So there you go. That's what's going with property prices at the moment. Now, actually, that sees the end of this episode as well. So I think just to wrap it up, thank you, as always, for watching. You know, we really appreciate it. And please do leave any feedback for things you'd like us to cover off in the notes below. Last week, someone commented, which was really interesting, that actually there's a real kind of interest from landlords about estate planning, which is fascinating because I've never really considered that might be something that you guys would want us to talk about. Now, estate planning, just to kind of follow on from that, is not something that I would really be able to talk about because this is real tax advice now. But what we are going to do on the back of that feedback is put together a whole webinar on estate planning, which we hope you'll find useful. So keep your eyes peeled for that one. But if there's anything else at all, just let us know. Thank you so much for joining us. Have a fantastic week. Don't get sunburnt, and I'll see you same time again next week.